Oil has dropped from its peak of about $112 on April 8, 2026, following the Iran war. Gas prices tick down. Headlines are suggesting that inflation is somewhat cooling. So why did your grocery bill go up this week? Hey everyone, welcome back to the channel. I'm Lekan Steven. Today I'm going to show you something most financial media will never explain to you in plain English. And if you understand it, and most retail investors don't, you'll know exactly how to position yourself for what's coming over the next 12 months. There's a delay built into the global economy, a pipeline that takes raw cost shocks and pushes them through months of contracts and supply chains before they ever hit your wallet. And right now, in this moment, that pipeline is still digesting costs that got locked in last year. Here's why it matters for your portfolio. If you don't understand this delay, you're going to do exactly what the average investor is about to do. You'll rotate back into stocks at the top. You'll buy bonds at these yields. You'll think the worst is over. Let me walk you through it. Here's the lie you've been told about inflation, that it's reactive. Oil goes up, prices go up. Oil goes down, prices go down. Wrong. This is a dual-axis chart from San Francisco Federal Reserve data. The blue line is global crude oil prices, falling off a cliff. The red line is core consumer inflation. Notice anything strange? It's not following, it's staying flat. Sometimes it's even climbing. Why? Because the inflation hitting your wallet today isn't based on today's energy prices. It's based on industrial contracts that got signed 6 to 9 months ago, when trucking companies locked in fuel surcharges, when manufacturers signed off on input costs, when wholesalers negotiated their next quarter of purchases. Those contracts don't magically disappear when oil drops. They're sitting there, fully priced in, slowly working their way through the system like a slow-moving wave. And the only way a price spike gets out of the pipeline is by passing through every single stage on its way to you. Most investors don't get this. They watch the monthly CPI print and they think the Fed has control. They think headline numbers reflect what's happening right now. They don't. Headlines reflect last year's reality, distorted and delayed. Stay with me, because once you see the 4 stages of this pipeline, everything else snaps into focus. The Bureau of Labor Statistics, a boring name, critical data, actually tracks this entire process with something called the Stages of Production Framework. Stage 1, raw materials, energy extraction, crude oil, natural gas. When a supply shock hits, this is where it lands first. Stage 2, chemical production, agricultural feed formulas, plastics, fertilizers. This is where the shock gets concentrated. A small spike at stage 1 turns into a severe price spike here because every downstream product needs these inputs to exist. Stage 3, wholesale and transport, shipping containers, freight, logistics. The intensity starts to dilute, but the shock spreads across a much wider range of goods. Stage 4, retail, construction, the consumer-facing layer. By the time it lands here, the intensity drops, but the reach is everywhere. Every category, every aisle, every single line item on your monthly bills. And the San Francisco Fed quantifies this precisely. A 3.5% spike at the intermediate level shows up as roughly 2.5% inflation at the consumer level, but it's hitting everything at once. Coffee, diapers, rent, insurance, your kids' daycare. Researchers have a name for this. They call it the snake effect. The supply chain swallows the cost shock whole, but it digests it very slowly, guaranteeing a delayed, flattened, but inevitable impact on you. So if oil dropped 6 months ago, when does the consumer actually see it? Maybe now, maybe 3 more months from now. The pipeline doesn't care about news cycles, it cares about contracts. And here's where it gets worse, because once the pipeline finishes digesting, the prices don't go back down. Let me show you why. Look at this graph, modeled on European Central Bank research. Energy shock hits, inflation spikes. We'd expect the line to return to baseline once the shock clears. It doesn't. It stays elevated permanently. Why? 2 words, real wage resistance. Here's the mechanism. When everyday goods get expensive, workers experience a drop in their real income. Their nominal paycheck looks the same, but they can buy less with it. So what do? They demand higher wages. They negotiate harder at performance reviews. They job hop for a 15% bump. They strike. They unionize, whatever it takes to claw back the purchasing power they already lost. This creates a second wave of upward pressure on inflation. Not from energy, from labor. Meanwhile, companies are sitting on fixed bid contracts they signed before all this started. So now they've got expensive locked-in input costs and newly elevated labor costs. To defend their profit margins, they raise prices on their domestically set goods, on their services, on everything they can. This is the part you can't unsee once you see it. What started as a temporary energy shock has now mutated into structural core inflation. Human behavior, labor contracts, and corporate pricing decisions have calcified the higher prices into the system. They're not going back down. The economy doesn't reset. It resets at a new, permanently elevated baseline. This is why CPI prints stay sticky even after every transitory assurance from policymakers. This is why your $200 weekly grocery bill from 2021 is now $290. And it's not going back. This is structural, not temporary. And it brings us to the most important question for your portfolio. Has this happened before? And what did the Fed do when it did? This is the New York Fed's Global Supply Chain Pressure Index. The crisis of the early 2020s was historically exceptional. The index spiked 4 standard deviations above its historical mean. 4 standard deviations. Statistically, that's a once-in-a-century event. So naturally, people compare it to the 1970s. They assume the inflation of that decade was caused by the 1973 oil embargo. That's wrong. Look at the data. Dallas Fed numbers show that year-over-year inflation in the U.S. had already surged to 7% before the embargo ever hit. The oil shock was an accelerant. It was not the cause. The cause was loose money, supply constraints, and exactly the kind of real wage resistance we just talked about. So what broke the inflation of the 1970s? It wasn't a magic recovery in energy prices. It was a man named Paul Volcker. When Volcker took over the Federal Reserve in 1979, inflation was running at 13%. And he did something most central bankers would never dare to do. He hiked short-term interest rates to nearly 20%. He intentionally crushed economic growth to break the back of inflation. The recession that followed was brutal. Unemployment hit 10.8%. Manufacturing collapsed. Farmers lost their land. Construction workers blockaded the Fed building. Volcker got actual death threats in the mail. But it worked. Inflation came down. The dollar stabilized. The 40-year bull market in bonds was born. So here's the question every investor needs to ask right now. Can the Fed do that today? Volcker had a U.S. national debt of about $1 trillion to work with. Today, that number is over $40 trillion. The math has fundamentally changed. Every single percentage point on rates now costs the federal government hundreds of billions of dollars in interest payments. The Fed today isn't in Volcker's fight. They're in a much worse one, and they have a choice to make. Here's the choice. I'm going to make it as clear as I possibly can. Door 1, the Fed raises rates, keeps them high, forces a recession, breaks the inflation spiral the same way Volcker did. But unlike Volcker, the Fed today is doing this with $40 trillion in debt sitting on the books. Every rate hike makes the government's debt service exponentially more expensive. At some point, the math just breaks. Interest on the debt becomes the single biggest line item in the federal budget. Treasury auctions start failing. Bond markets seize up. Door 2, the Fed cuts rates, pivots, stimulates the economy, saves growth in the short term. But that means inflation runs hot. The currency debases. Your purchasing power erodes year after year after year. The cost of living keeps climbing while wage gains lag behind. And the middle class gets quietly, methodically crushed. Most financial media will tell you the Fed will always choose door 2 because central bankers prefer quiet inflation over the loud pain of a recession. That's historically false. Volcker chose door 1 in 1980. He proved the central bank is fully capable of inflicting severe economic pain when it has to. But the math of $40 trillion in debt creates fiscal pressure Volcker never had to navigate. And that pressure tilts the table. So which door will the Fed pick? Honestly, nobody knows. They might oscillate between them. Hike for a few quarters, then capitulate when something in the market breaks, then hike again. That whipsaw destroys investor positioning either way. What you need to know is this: both doors damage different parts of your portfolio. There is no clean exit. There is only positioning for which door is more likely. Let me show you exactly how each asset class responds. This is where the rubber meets the road for your money. Let's go category by category. Equities. A stock is a claim on future corporate earnings. The pipeline we just walked through, input costs locked in months ago, real wage resistance pushing up labor costs, crushes profit margins before companies can fully pass costs to consumers. Margin compression hits the bottom line first. Look at any earnings season in the last 2 years and you'll see this story over and over. If door 1 hits, higher rates, valuation multiples compress on top of the margin hit. That's a double whammy. If door 2 hits, looser policy, nominal earnings might grow, but real returns get quietly eaten by inflation. Either way, the broad market struggles. Bonds, especially long duration. If the Fed picks door 2, accommodates inflation, the fixed coupon on your bond gets systematically destroyed in real terms. You're locked in at 4% while inflation runs at 6%. You're losing purchasing power every year you hold it. If door 1 hits, rates go higher, existing bond prices fall. There's still a place for bonds, short duration, inflation protected, but the traditional 40% bond allocation in a classic 60-40 portfolio is broken in this regime. Hard assets, commodities, gold, these carry no profit margins to compress. They don't have a CEO defending earnings on a quarterly call. Historically, they reprice upward to reflect the debasement of the underlying currency. Especially in a door 2 scenario, gold has been the single best performing major asset class in every inflationary regime of the last 100 years. That's not a coincidence. That's structural. Here's what this means for you personally. The traditional 60-40 portfolio relies on stocks and bonds being negatively correlated. When stocks fall, bonds rise. The balance is built on a demand-driven inflation model. Supply-driven inflation breaks that correlation. Both can fall at the same time. We saw it in 2022, the worst year on record for the 60-40 portfolio. If you're still running that allocation, you are not protected. You are exposed. A lot of you are going to ask about Bitcoin. So let me address it directly. The bullish argument is real. Bitcoin has no supply chain, no corporate margins, a mathematically fixed cap of 21 million coins. It operates entirely outside the industrial pipeline we just walked through. In a pure door to scenario, money printing, currency debasement, Bitcoin's design is theoretically the cleanest hedge in existence. But here's the counter-argument. Bitcoin doesn't trade in a vacuum. It carries extreme volatility. And historically, it correlates heavily with high-risk tech equities. So if door one hits, if the Fed actually drains liquidity to fight inflation, Bitcoin tends to fall with the rest of the risk on trade. We saw 80% drawdowns in 2022. Size it accordingly. Bitcoin is a leveraged bet that the Fed eventually capitulates to the weight of the national debt and chooses door two. It's a high conviction macro thesis. It is not a hedge for everyone. Size it like you'd size a high conviction bet, not like a savings account. Let me give you the bottom line. The 6-month inflation lag is not a conspiracy theory. It's not a doom narrative. It's a mechanical reality of how supply chains process cost shocks. Energy can drop tomorrow and your grocery bill is still going to climb for months because the pipeline is still digesting last year's cost. The Fed is pinned. Door one risks a debt crisis. Door two risks structural debasement. There is no comfortable middle ground anymore. To survive this regime and to actually grow your wealth through it, you have to look past the headlines, past the monthly CPI prints, past the Fed press conferences. The pipeline doesn't lie. The pipeline just delivers. Now, I want to hear from you. I'm pinning this question to the top of the comments. Drop your answer below and let's debate it. If you were running the Fed today with $40 trillion in debt sitting on the books and structural inflation calcified into the system, would you choose Volcker's path and force the recession? Or would you accommodate and live with the debasement? There's no clean answer, but the way you answer says a lot about how you should be positioned right now. Comment below, let's get into it. Thanks for watching. If this changed how you think about your portfolio, hit subscribe. I'm putting out one of these every week, breaking down the stuff financial media won't touch. See you in the next one.